Capital gains tax is an extremely unfair tax to investors. Let me explain why. It is basically a tax on inflation. Think about this. When you receive income from a job, those are in current dollars. When you get rental money or royalties, it's in current dollars. But when you're doing capital gains, you're comparing a price you got for selling it this year to the price you bought it for in the years past. Well, in between those years past, those aren't the same dollars. There's been inflation. And the fact that you are paying a higher price doesn't mean that what you're selling has increased in value. It just takes more dollars to buy that same thing because the dollars have become devalued. Now, it depends on what the rate of inflation is. The government says the rate of inflation is like 4%. Do you believe that? Maybe it's more like 10%, like some others say. John Williams at Shadow Stats says that the US government inflation rate is even higher on an ongoing basis. Here's the problem. You buy a house, you call it a rental house, it's not a personal living house. You buy it for $300,000. 5 years later, you sell it for $500,000. The value of the house really hasn't gone up. In fact, the house has gone down somewhat because it's 5 years older. It's got 5 years more wear. But it's gone up in value. It's gone up in value by $200,000. And now you're going to have to pay capital gains tax on that. So let's say that's 20%. So 20% of the $200,000 is $40,000. They're taxing on income you made, but you didn't make the income. It's just inflation. They're taxing what they're inflating. Inflating is a form of stealing, and then they're taxing you on what they're stealing you. Does that make sense? Is that good? And what happens is then, let's say you're a buyer of Bitcoin. You bought Bitcoin at $10,000 and you wait a few years and now it's $1 million. Okay. It's still the same Bitcoin. The quality of that Bitcoin has never changed. Instead, the value of assets around it have declined. It's declined substantially because the dollar is dropping so fast because of money printing. So why should you be taxed on $990,000 of gain? The government would then propose to take 20% of that, or about $200,000 from your gain. What did the government do to merit that they should get a fifth of your gain? You're the one that bought it. You're the one that suffered the emotional turmoil of hodling it for those years. And now the government gets to take 20% of it. Actually, more than 20%. If we add in the NIT tax, it gets up to about 24%, which is closer to a fourth of what your gain is. It's not fair because it's a tax on the government's inflation, but you have to pay. What is the solution to this? How can we do this? One person has proposed that we should index the sale of long-term assets based on inflation. That is to say, the longer you've held the asset, we multiply it times a factor of what is it going to be taxed because of inflation. Well, if you trust the IRS to come up with a fair inflation rate, that might be one way to do it. Another approach, which is done by a lot of governments in Europe and Asia, is to simply, any asset you hold more than a year, you're not taxed at all. It's zero tax rate on assets held greater than a year. Why is this a great strategy? Well, first of all, the purpose of having short-term and long-term rates are to prevent churning in investment. Because churning for the investors, let's say it's a corporation, stocks, or it does not really create healthy growth for that asset. In fact, assets do better when people buy and hold them. It creates stability, liquidity, etc. So it is a great incentive. And to give up on long-term capital gains tax, I think has a very low impact on the economy. And by doing this, you will actually stimulate investment in the United States. So what do you think? Should the government step up now as we're looking to change the taxes with the clarity law? Maybe this is the time that Donald Trump steps in and says the capital gains tax is a negative tax because it taxes inflation and it's unfair, and he's going to strike the enforcement of that from the tax code on the long-term capital gains. I have another idea for you too about capital gains tax. If you have more losses than gains, the amount that you can write off is limited to $3,000. It's called the capital gains loss limitation. Well, that $3,000 is not indexed to inflation. I mean, $3,000 is barely a month's rent. So when it first came out back in 1986, that was a lot of money. In fact, it was substantial. It could have been several months worth of money. And why should it be such a large amount of money at that time? Well, because the idea is that if you're investing and you're a smaller investor, you deserve to get some tax break for trying to stimulate the economy. So that's why it was meaningful. But inflation has eroded $3,000. Depending upon what the interest rates are, that should be somewhere closer to $20,000, maybe $50,000 capital loss limitation to allow you to be able to write off the losses in the years that you experience them. What do you think? Like, subscribe, and follow. Your feedback is very important to us.